Welcome back. Today, we're digging into the latest earnings from Capital One. And let me tell you, this is a big one. This isn't just your average quarterly report. Nope. This is the first real glimpse we're getting of a banking giant right in the middle of a huge transformation. Okay, let's get into it.
So, right out of the gate, here's the number that has everyone talking. $3.2 billion. That's the net income Capital One just posted for the third quarter. It's a massive figure, and you have to ask, where in the world did that come from?
Well, a number like that isn't just about profits. For Capital One, it's the payoff from a huge, calculated, company-changing bet. And today, we're going to unpack the story behind that number, piece by piece.
All right, first up, let's unpack those blockbuster results, the ones that made all the headlines. So here are the official figures. A net income of $3.2 billion, which works out to $4.83 per share. Now, to put that in perspective, that is a huge swing from last quarter and an incredible jump from this time last year. So what on earth happened?
Well, the company's CEO, Richard Fairbank, pretty much gives us the biggest clue right here. He points straight at the integration of Discover. This one move, this single decision, is the key to understanding everything else we're about to see.
And that brings us right to the main event of this quarter, what we're calling the Discover effect. Let's take a look at just how much this one acquisition completely changed the game for Capital One. You know, plain and simple, the engine behind all this crazy growth is the Discover acquisition. But this wasn't just about buying another credit card portfolio. See, Capital One also bought a payments network. That means they're not just a company on the card anymore. They're now in the same league as Visa and MasterCard, actually processing the transactions. It's a massive strategic shift, and the numbers it's producing are just staggering.
And this chart just says it all. I mean, look at this. A year ago, Q3 2024, Capital One's net revenue was about $10 billion. This quarter, it shot up to $15.4 billion. That's not just growth. That's like strapping a rocket to your business model.
Now let's break that down a bit. Total net revenue is up 54% from last year. Pre-provision earnings, that's basically what they earn before setting aside money for potential bad loans, is up 51%. And their bread and butter, the credit card division, revenue there jumped by a whopping 60%. These are the kinds of numbers you just don't see every day. This is the Discover effect, right there in black and white.
Now, you'll often hear companies talk about two sets of numbers, GAAP and adjusted. Think of it like this. GAAP is the official by-the-book number that has to include all the one-time costs, like paying for the merger. But analysts really like to look at the adjusted number because it pulls out those temporary costs. It gives you a much clearer picture of how the actual day-to-day business is doing, which, in this case, shows an even more impressive adjusted earnings of $5.95 per share.
Okay, so the big, shiny new acquisition is obviously a home run. But is the rest of the company firing on all cylinders? Let's take a quick peek under the hood at their core businesses.
The credit card division is just on fire. The amount of money people are actually spending on their cards is up a massive 39% from last year. That means customers aren't just holding the cards, they are actively using them, which is exactly what you want to see.
And it's not a one-trick pony either. Over in their consumer banking segment, auto loans are up a very, very healthy 17%, so they're growing market share in other key areas too.
So what about their loans to big businesses? Well, the number to watch here is the net charge-off rate, and at just 0.21%, it is incredibly low. What this tiny number tells you is that they aren't just lending to anyone. They're making really smart, high-quality loans to stable businesses.
So the company is growing like a weed. Fantastic! But is it reckless growth? Is the bank still safe? Let's check in on the financial health by looking at some key stability numbers.
First up, the CET1 capital ratio. Now, that sounds super technical, I know, but the idea is actually pretty simple. Just think of it as a bank's main financial safety cushion. It's the buffer they have to absorb a big, unexpected shock. And the bigger that cushion, the safer the bank is. And here's the amazing part. Capital One's cushion isn't just big. It's actually getting bigger. It grew from 13.6% last year to 14.4% now. So even after making this gigantic acquisition, the bank actually became financially stronger, not weaker. That is seriously impressive management.
Next up is something called the liquidity coverage ratio, or LCR. This is basically another stress test. It asks, hey, if a major crisis hits, does the bank have enough easy-to-access cash to survive for 30 days? By law, this ratio has to be above 100%.
And Capital One isn't just squeaking by here.
They're sitting at 161%. That's way, way above the minimum requirement. It means the company has a massive amount of liquidity on hand, making it incredibly resilient to shocks.
Okay, we have covered a ton of ground here. So what does it all mean? Let's boil this entire incredible quarter down to the key takeaways.
If you only remember 3 things from all this, make it these. First, the Discover acquisition has totally changed the game, igniting blockbuster growth. Second, it's not just about the acquisition. Their core businesses are also performing exceptionally well. And third, and this is so important, they did all of this while making the company's financial foundation even more rock solid.
Which really leaves us with one big final question. Capital One's huge bet on Discover is paying off spectacularly right now. But the really hard part is just beginning. Merging the technology, the people, and the cultures of 2 enormous companies. The question now is, can they keep this momentum going and make it all work for the long haul? That's the story we'll all be watching.